Welcome back to the Deep Dive. Our mission today is pretty specialized. We are going inside the institutional analytical framework, specifically the one senior portfolio managers use to interpret closing market action on a challenging day like December 10th, 2025.
Exactly.
We're working with some pretty high-level notes and analysis here, the kind of stuff designed to help professional managers filter out all that daily noise and, identify genuine conviction. So if you want a shortcut to understanding how smart money really reads the tape and positions for the next day, this is the deep dive for you.
That's really the core objective. For a PM, the daily close isn't an ending. It's the final piece of evidence they need to define their strategy for tomorrow. So we're framing this whole discussion around that intersection of price, volume, and implied volatility dynamics.
Yeah.
We need to figure out if the big players were buying or selling aggressively, and how their actions either confirm or, contradict the quiet signals hiding beneath the headline indices.
Okay, let's unpack this then, starting with the closing bell. How exactly do institutions read the conviction or the lack of it in that final 60 to 90 minutes of trading for the SPX, the NDX? What are the non-negotiable signs they look for?
It boils down to intensity and persistence. If a senior PM is looking for signs of institutional accumulation, they need to see two things happen together. First, a sustained upward price trend right into the close. And critically, that movement has to be accompanied by increasing or consistently high volume. The ideal scenario is the closing price settling right near the day's high or even pushing to a new intraday high in that last hour. That signals deep-pocketed players are willing to pay up and hold overnight.
And if they're distributing, offloading positions?
Then it's the clear opposite. You'd see a distinct downward move into the close, and this has to happen on elevated, heavy volume. If the close settles near the day's low, or if we see a sharp reversal from earlier highs, that's institutions aggressively exiting. It's a classic flushing mechanism.
But what if you have a massive sustained rally all day, and then the last hour is just flat, choppy, and quiet?
That is the classic sign of uncertainty, or just position squaring. If you see that kind of range-bound action on diminishing volume as the bell approaches, there's no institutional conviction. It's thin liquidity, often just retail or smaller funds wrapping up. The smart money has either finished their business or they're just waiting for tomorrow.
Okay, so beyond that visual assessment of the final candlestick, the framework relies on technical benchmarks to confirm true institutional participation. We often hear about VWAP. Help our listener understand why the volume-weighted average price is so critical here.
VWAP is foundational. It's foundational because it represents the true average price where all the volume was traded throughout the day. You can think of it as the institutional average cost basis. So if the market closes significantly above VWAP, especially with that strong late-day volume we just discussed, it implies the late buyers are paying more than the day's average cost. That's a clear indication of accumulation and momentum.
And conversely, closing below VWAP means the momentum faded, or selling pressure.
Overwhelmed the average demand, exactly. It suggests distribution took hold. The market closed cheaper than the weighted average transaction price. We also have to mention order flow, specifically market on close or MOC imbalances.
Right, MOC imbalances. They're the closest many of us get to seeing direct evidence of institutional activity right at the closing bell.
They're the fingerprints. A significant MOC buy imbalance confirms institutional accumulation. It shows they're rushing to fill orders right at the last minute. Sell imbalances confirm distribution. A PM looks at this in context. Did the index say, start the day weak but then close strong with a heavy MOC buy? That tells us institutions were absorbing selling pressure all session, turning that early weakness into late conviction.
That quality of the underlying trend and the participation behind it brings us seamlessly into looking for confirmation and, maybe more importantly, warning signs. We're moving beyond the simple close and asking, is this move reliable?
This is where we shift from, observation to critical analysis. If the price is rising and volume is rising, that's simple. It's straightforward confirmation of accumulation. The trend is validated. It's healthy. Same on the downside. Falling price, rising volume confirms distribution.
But the real money is made or saved by spotting when the trend is lying. Let's talk about that bearish divergence, the major red flag for PMs.
That red flag is when prices are rising into the close. So the tape looks strong, but the accompanying volume is visibly decreasing. It's spinning out. If the S&P is making new highs in the last hour, but nobody significant is joining the party, well, that rally is running on fumes. It suggests the latest moves are driven by light liquidity or retail chasing. It lacks participation from the smart money, and it leaves the market highly vulnerable.
So if the price is going up on low volume, the conviction just isn't there. It's a shallow move. What about the flip side? The bullish divergence. Price is declining, but volume is also falling sharply.
That hints at exhaustion. If prices are declining, but the urgency to sell is just drying up, which is what a significant drop in volume tells us, it suggests selling pressure is waning. You might be seeing quiet accumulation on dips, or simply that the sellers have run out of inventory. It's often a setup for a reversal because the path of least resistance has changed. And we also analyze the volume distribution profile. We don't just look at total volume, but where the bulk of it was traded during the day. If most of the activity was concentrated at lower price levels, that's accumulation on dips. If volume was heavier at the high end of the range, it signals institutions were distributing into strength.
Okay, we've established the quality of the price action. Now let's widen the lens and look beneath the surface. This is where we determine the overall health, maybe the fragility of the ecosystem, because the headline indices, the SPX, can mask serious underlying issues. Let's talk market breadth, the narrow advance.
The first thing we analyze is the health of the rally itself. Based on our D-Tense analysis, the market exhibits characteristics of a narrow advance. This is a huge risk indicator.
To put that in simple terms, it means the entire market performance is relying on a very small group of stocks.
Sure.
Right. It's not a broad-based move.
Precisely. We check breadth indicators. Are the NYSE and NASDAQ Advance decline lines showing genuine participation, or are they flatlining while the index screams higher? We saw only modest improvement in those lines. More importantly, we look at the percentage of stocks above their key moving averages, the 50-day, the 200-day. If those percentages stay low, it confirms the rally is driven solely by a handful of mega-cap leaders. Think your handful of tech giants.
That concentrates risk dramatically. If one of those leaders falters, there's no broad base of support to catch the market.
It creates significant vulnerability. Next, we have to address volatility, using the VIX. Spot VIX around, say, 16 to 17 reflects neutral sentiment. No panic, no euphoria. But the real signal is in the VIX term structure.
VIX futures, and this is where it gets really interesting. We're not just looking at where the VIX is today, but where traders think it will be in the coming months.
That's the difference between looking at the current speedometer and checking the weather forecast. Normally, the VIX futures curve is in contango, meaning later months are more expensive than the front month. It's the cost of holding insurance. What we observed was a noticeable flattening in the front month, that M1, M2 spread.
So the price difference between the current month M1 and the next month M2 is shrinking. Why is that signal so crucial for a PM?
Because it shows market participants are pricing in a higher probability of near-term volatility spikes. The premium for immediate protection is rising. The certainty that the current calm will persist is, well, it's diminishing rapidly. It's like watching the immediate weather forecast change from sunny to a sudden thunderstorm warning, even if the long-range outlook hasn't shifted much.
And on top of that, the VVIX, the volatility of the VIX itself, showed a slight uptick. That suggests options traders aren't just worried about market swings, they're worried about massive swings in the fear gauge itself.
It paints a picture of nervousness. And then you layer onto that the growing fragility due to deteriorating liquidity. We are seeing a gradual widening of bid-ask spreads in less liquid segments, small caps, maybe some high-yield debt. Simultaneously, order book depth in derivatives and less active equities is thinning.
And what's a practical implication of a thin order book?
It means market fragility increases dramatically. When there's less depth, fewer standing orders ready to execute, a large institutional block trade, especially a sudden sale, has a much more pronounced price impact. It can move the market far more quickly than in a deep, healthy environment. This increases the risk of sharp, amplified moves, sometimes known as flash crashes, because that natural absorption mechanism is gone.
That kind of environment leads us to the final internal warning sign, correlation breakdowns. This has to be the ultimate threat to traditional portfolio construction.
Exactly. We rely on government bonds to act as a hedge when equities sell off. Recently, we've seen inconsistent or even positive correlation between equities and bonds. When both asset classes sell off at the same time, that's the dreaded all-off scenario.
It's like realizing your parachute and your backup parachute both use the exact same faulty rope.
Yeah.
Your usual hedge is just gone.
That's a perfect analogy. These breakdowns signal a fundamental regime shift. Traditional diversification strategies are failing because the market is aggressively discriminating, and general market beta bets are no longer reliable. The PM needs a new playbook.
So let's look at that playbook. We're moving now to how senior PMs turn this assessment fragility, narrow rally, front-loaded volatility into actionable asymmetric setups for the next day.
First, where are the big players transacting right now? We look to dark pools. Dark pools are crucial because they reveal institutional intention without causing immediate market disturbance. Our analysis showed a steady volume of large block trades indicating continuous rebalancing. Crucially, the flow was balanced overall. You saw accumulation in defensive, high-quality names with strong cash flow, and at the same time, distribution in recent high flyers or speculative growth segments.
So institutions are operating with prudence. They're selecting their spots, showing high conviction in quality, but no overwhelming conviction in the broad directional move.
That's the takeaway. Caution rules. When planning the next day, PMs hunt for setups where the potential profit significantly outweighs the potential loss, the asymmetric risk-reward. To locate these, especially in modern markets driven by derivatives, they have to understand gamma.
You mentioned the word gamma. Now, for many listeners, that's where the options math gets really fuzzy. How does a PM practically use the concept of gamma to anticipate tomorrow's trading environment?
Think of gamma not as math, but as the market's internal accelerator or brake pedal. And it's largely controlled by options market makers. Gamma measures how quickly the hedging requirements of dealers change as the underlying price moves. We focus on the gamma flip point, a critical price level often tied to massive open interest.
Okay, so a key level on the chart.
Right. And if the market is above this flip point, we're in a positive gamma regime. The market makers are effectively long gamma. They act as dampers or brakes. When the market goes up, they sell futures to hedge. When it goes down, they buy futures to hedge. This force pushes the market back toward the center, leading to range-bound action and reduced volatility.
But if we fall below that level, the mechanism reverses and the market makers become the force that actually amplifies the move.
Exactly. You enter the negative gamma regime. The market makers are short gamma. They become the accelerator. If the price falls, they have to sell more futures to hedge, pushing the price down faster. If the price rises, they buy more futures, accelerating the upward move. This is why moves below the flip point can be so violent and so fast.
So the PM's top priority is identifying that current gamma flip level, because it really defines the rules of the game for the next day. Once they have that, they look for liquidity pockets. What are those, and how do they align with gamma?
Liquidity pockets are critical price areas, prominent swing highs, lows, psychological round numbers that are known to hold high concentrations of stop-loss orders. For a large institution to enter or exit a block position efficiently, they need liquidity. These pockets provide it when triggered. They are prime targets for stop hunts or liquidity grabs right before a genuine reversal.
And the beauty is when these two things line up.
That's the setup. You look for a liquidity pocket that coincides with a major options level, such as a heavy, out-of-the-money call concentration, what we call a call wall.
And that combination creates an asymmetric trade. You position yourself right at that confluence point.
Absolutely. If the market attempts to breach that call wall liquidity pocket but fails, it offers an asymmetric short opportunity with a very tight stop loss. You're betting the market snaps back into the positive gamma namping regime, or maybe accelerates down into negative gamma territory. It's all about capitalizing on the forced hedging behavior of the market makers, not so much the economic fundamentals.
Okay, let's summarize the overall assessment then.
To summarize our assessment of the day's action, the market remains a narrow rally. It's relying on a few leaders, and it's characterized by deep institutional caution. And beneath that neutral spot VIX, we see emerging fragility in liquidity and definite shifts in volatility expectations via the term structure. Vigilance is warranted.
Which leads directly to the strategy advocated in the source material. Reduce beta exposure, maintain a strict focus on quality, looking for strong balance sheets, high free cash flow, and utilize tactical hedging. And maybe the most strategic point, maintain dynamic liquidity management. Keep cash reserves ready to capitalize on the dislocations that thinning liquidity of flash moves could create.
That is the necessary playbook for a fragile, discriminating market.
And here's a final provocative thought for you, the listener. Given this deep dive into the VIX term structure flattening and the prevalence of this gamma-driven hedging by options market makers, what if the greatest risk right now isn't the underlying economic news or even the Federal Reserve, but the purely mechanical process of those market makers being forced to amplify moves once a critical options level, that gamma flip point, is breached? It suggests that volatility shifting from being an external reaction to news to an internal systemic risk of the market structure itself. Think about that as you review the tape tomorrow.